Good morning, all. Today we are going to discuss about one of the important question of monetary policy. Introduction to the monetary policy. The Reserve Bank of India Act in 1934 was amended by the Finance Act in 2016 to provide for a statutory and institutionalized framework for the Monetary Policy Committee. So it is also in the Reserve Bank of India Act in 1934. It was amended by the in Finance Act in 2016. It can be provided for the in a framework for the monetary policy for maintaining prices stability while keeping in mind the objective of growth. So it can be framework to the inner price stability and keeping the inner growth rate. The Monetary Policy Committee is instructed with the task of fixing the benchmark policy rate, so repo rate required to in contain inflation with the specified target levels. So the monetary policy can be in a tax fixing. Benchmark and policy rate, the repo rate means the RBI it can be fixed to the financial to the some financial institutions or commercial banks also required to the in contain inflation with the in specific target levels. So it can be in specific target to the some inflation. The government of India in consultation with the RBI. So it is also government of India consultation to the RBI notified the inflation target in the Gazette of India dated in 5th August 2016 for the beginning from the date of in publication of the notification and ending the March 31st, 2021 as the 4%. So it can be fixed to the some rate of interest. So it can be targeted to the in 5th August 2016 period. It is also in beginning. So ending of the in March 31st, 2021. The same time lower and upper um, tolerance levels was notified to be into percentage and 6% respectively. So it can be some rates of in 2% and 6% respectively. It can be maintained to the in OPM. What are the main instruments of the in monetary policy? So, open market operations in first one. An open market operation is an instrument which involves buying and selling of securities like a government bond from or the in public and banks. So, the open market instruments it can be involved to the in buying and selling of some securities and bonds in public and banks. The RBI sells in government securities to control the flow of credit and buy government securities to increase the credit flow. So RBI can be sells to the in government securities and also it can be control to the flow of credit and it can be increased to the in government credit flow also. So next one cash reserve ratio CRR. So cash reserve ratio is a specified amount of bank deposits. So it is also specified amount to the bank deposit, which banks are required to keep with the RBI in the form of a reserve for the balances. So some banks it can be maintained to the resource and balances. The higher the CRR with the RBI, the lower will be liquidity in the system and vice versa. So it is also lower to the liquidity system. The cash reserve ratio reduced to the 15% in the 1990 to 5% in 2002. So it can be rate to the in a 15% to the in 1990s and 5% in 2002. As of in 31st December 2019, The CRR is the 8.4 percentage of the in 2019 in December 31st. It can be maintained to the in our way. So next one, statutory liquidity ratios. All financial institutions have the maintain a certain quantity of liquid assets with themselves at any point in time of their in total uh, and demand liabilities. So every financial institution it can be maintained to the some liquid assets also. This is known as the statutory liquidity ratio. So the assets are kept non-cash forms such uh, precious metals, bonds, etc. So it can be kept to the non-cash forms. So it is also precious metals, some bonds, etc. As the December 2019, the statutory liquidity ratio stand at the 18.25 percentage. So it can be maintained to the in 2019. So next one, bank rate policy. The bank rate policy is also known as the discount rate. Bank rates are interest charged by the in RBI by providing to the funds, loans, and banking system. So it can be RBI providing to the some funds. An increase in bank rate increases the cost of borrowing in commercial banks, which results in a reduction to the credit volume of the bank. Hence, the supply money in declines. So it can be in bank rate also will be increased. The borrowing cost also increased to the some commercial banks. It can be reduced into the volume of in banks. So it can be declines the some supply of money or financials and increasing in the bank rate symbol the latent of the RBI monetary policy in 31st December 2019. So 5.40 percentage of the in 2019 31st December it is also in bank rate policy to be maintained. Credit sellings with in this instrument the RBI issue in prior information for a reduction that loans the commercial bank will be give after a certain limit. So in the case in commercial banks will be in a tight in advancing loans the public. So it is also issue prior information to the some bank bank. So in this case, the commercial bank will try to in advancing loans to the in public. Uh, they will allocate loans to limit sectors. So it can be allocated to the limit of the sectors. A few examples of in credit selling or agriculture sector advances and priority sector in lending. So it can be some commercial banks, financial institutions issuing to the some commercial loans and advances also. In this points are involved to the instruments of a monetary policy.